So this is a trade breakdown video for the most recent trade posted into the channel. This should be a fairly short video, but this model, right? This is the model that, you know, this is a very visually easy entry model, right? And the criteria for it is very, very easy. You guys, can make a note of it, and we're gonna dissect each part of the trade and the reason for the entry, right? The entry isn't the hard part. It's the reason for taking the trade, right? This is what we're going to go through essentially. So here, now you can't see this on the 5 minute, right? The 5 minute is the easy part. This, right, 1 hour, 4 hour, you'll see when I put the my indicator on. This is midnight's opening price, right? From here, imagine midnight's opening price going across here, and we traded down, right? Now we traded down lower, right? And we made a distinct low inside of London. Now we rallied higher, and I'm favoring the close of the candle to be, you know, above the open. So in saying that I favor it to be above the open, I'm gonna wait to get underneath midnight's opening price and work my way back to midnight's opening price, right? Essentially, you'll see what I'm saying because we're gonna do the same thing now, but for an hourly candle. Notice the time. It's early on in the hourly candle of 9 a.m. to 10 a.m., right? Look at the time here. This is what we're working in. I'm expecting an open, low, high, close delivery. Rejection block, right? I'm expecting the next candle to push higher. Now, given that, we're going to mark the opening price, trade underneath it, find an entry around here, and then, ride the expansion. This is all you're doing. This is the framework, right? This is just the entry. Now, what do I look for? This is the direction that I'm working in. Now, what am I looking for in a stage, right? And you guys will see it here. Just put this down now. So you're gonna see this now. I mark this as an open now. Well, of course, I post this on like Twitter and Telegram, and people asking me why is this the open? How is this an open? It's the hourly candles open. I'm working in that hourly candles direction. So now if I'm bullish, right, and I'm favoring an open, a low, high, close delivery on this next hourly candle for euro, what am I waiting for? I'm waiting for a protraction into a level of PDA or a run on a low. It's all about this. The opening price, can it protract into some sort of time frame under it into a PD array? So this is hourly. So was there like a 15 or 5 minute PD array that it can open, manipulate into, and then begin its expansion, right? Now, you guys always want to ask about shaving stop losses, right? So let's talk about shaving the stop loss. Stop loss will get shaved here. Now, I'm not going to shave it to the fair value gap close. I'm going to shave it to the candle that contains the fair value gap, because this is a bullish fair value gap, the low of that candle. Now, if this was a short off of a fair value gap, and I see that we had institutional order flow entry drill going my way, I would trail the stop loss to the high of the candle that contains the bearish fair value gap. That is all that there is behind the shave of the stop loss. A way that people shave the stop losses as well could be, so having your stop loss at the low, and as price is going in your favor, shave your stop to a PD array. So, you had this order block here, and if your trades around up here, people perhaps want to trade their stop loss to the order block to the fair value gap. Me personally, I like to use the fair value gap close, the candle lows and highs that contain the fair value gap. I just find it more effective. Now, people would be very aggressive in trading the stop loss to this close here, right, or under this candle. Now that's an aggressive shave. You can shave it, it's not a bad idea, right? But considering that fair value gaps can get traded into a few times before expanding away, your stop loss is, there's still a chance of you getting hit out and then price continuing in the like, in your take profits direction. Hence, I feel like this is the more, safer shave, right? by all means, if you see this displacement and the candle closes through this fair value gap, around where break even is, you could just cut the entire trade. And, even though your stop loss is here, it doesn't mean you can't just manually leave the trade, right? The easiest way to shave the stop loss is this, right? Where price is right now, because, as price is developing inside of your trade, as price is going your way and you're considering a shave on the next candle's open, think about, if I was to enter this trade right now, where would my stop loss go on this trade? Now, if your stop loss will still go to the same place, there is no shave. If there is a clear invalidation level where if you entered price right now in this trade, I would put my stop there, shave a stop loss there. That's it. That's as easy as you can make it. Now, of course, from institutional order flow entry drill, we expect to run on buy side. Okay, this here is the crux of this trade. This fair value gap, this indicated buy program to be favored, right? And I said I'll break this down for you. So now, if you've read the most recent document that I made for you guys, the direction one, we consider fair value gaps a lot. And what did I say towards the end of that section, right, of the whole document? I said the market is always going to look to rebalance a fair value gap or to deliver liquidity above the highs and underneath lows. Now, what does it mean if you see an old fair value gap get disrespected then? It's not a program to rebalance the fair value gap or the imbalance. Rather, it's probably going to reach for that size liquidity. Now, even though that this fair value gap was tested, right, and traded, into and away, regardless, trading through this fair value gap now, displacing through that, shows what? It shows that this high is going to be, on the plate for buy side delivery. Because otherwise, this should have found support again, right? So consider that. Even if you have a fair value gap, that's rebalanced. Because I know you guys are familiar, because loads of times I've mentioned in other trade breakdown videos, and even in the direction document, I said when you see a fair value gap, an opposing fair value gap get disrespected and displaced through, then it is likely that that size liquidity, so if there's a bearish fair value gap that gets displaced through, the high is probably being targeted to deliver buy side liquidity. Given the fair value gap is sitting at least 50% of the range, around 50% of the range. Otherwise, if it's very if it's a bearish fair value gap, very deep, like deep discount, you can, it's not enough confirmation to displace through that to continue higher. It needs to sit around 50% of the range. This, if you can measure eyeball the range from high to low, you see it's around 50%. Displacing through here now, right, shows what? There's an intent to reprice. Okay, so buy side target. In line with the hourly expansion, we have a bullish PD array. That is all you need for a stage. The direction from the 1 hour. On your lower time frame, you see price displaced through an opposing fair value gap. You see that there's another fair value gap going your way, for you to enter the trade bullish. Price retrace into there. That's your entry, save stop loss, and target the buy side liquidity pool. This is the model that I used to literally just trade on an intraday level. Even if I see this on a higher time frame level, I would swing trade this. It's a very repetitive model as well. When you see this fair value gap get traded through, your mind should shift straight to a buy side liquidity delivery, given the overall time frames, H1, H4 are in line with a buy side expansion. That's literally the crux of the trade. The rest is literally just the trade playing out. Now, break even shave when this buy side liquidity pool is met, because when this buy side liquidity pool is met, right, there's no need for me to have risk on the trade, because when this buy side liquidity pool is broken, this low is going to be the new anchor, because we done an institutional order flow entry drill breaking that high. If we broke that high and then came back to take out this low, we would go and take out this low as well. That would just be a turtle soup on this high, right? So my stop loss, the entry being at the low of that candle, would just be break even. There's one more aspect of the trade. Okay, we didn't get it here. Yeah. Okay. So a lot of you guys struggle with cutting trades. You say, oh, I just saw a candle go against me, and I cut out the trade and then it went my way. How you feel, guys, yeah, it has no bearing on what price is going to do. If you don't like what price is doing, it's not going to change what it does. Even you can talk to your screen, you can clench your fists, you can sweat as much as you want. It's not going to change the candle's print, right? Now, you need to kind of eliminate your feeling, right? Now, eliminate acting upon your feelings is probably the better way to say it. If there is no technical, right, that is screaming at you to leave the trade or to take whatever profit you have and just get out, then stay in the trade, right? We have this fair value gap here for a reason, right? If we displaced and we closed, right? If we closed outside of this box, this fair value gap, didn't hold, then we can just cut the trade. But seeing this candle come down, wick away, test it, and it's not even a candle close, it's just a wick. Because remember, we care about where the bodied close of the candle is, right? There's a saying, right? The wicks do the damage and the bodies tell the story. Like this, right? You see how we wick down into it and the body close, to the essentially where it opened. Unless you get a bodied close through the fair value gap, stay in the trade. There's no reason for you to not stay in the trade. Now, you might wick away from it and then it goes down and closes you out of a loss. That's just a loss that your system's going to incur if you're trading fair value gaps, right? This is how you have to, this is how you yield consistency. You have to consistently enter the same thing, consistently manage it in the same way, and have consistent targets. Every, to have consistency in trading, in every single process of your trade plan, you need to do it the same way. Same entries, same time of day, preferably the same model for now. You can have one or two models, right? But for now, get comfortable with just one. Same time of day, same management of the trade, right? Using the same methodology, right? And not the how it looks like, but when there's a new invalidation level, shave my stop loss there. This way of managing the trade, you have to get used to consistently doing it as well. And this is how you get consistent results. Now, we're going to cover this in the weekly commentary, right? I'm going to show you a depiction of this model inside of the weekly commentary. I shared it with the Interbank guys before this model actually unfolded, right? Need to zap this opening price. Let's talk about this quickly, and then we'll go more in depth in the weekly commentary. This opening price, we expanded down, we created a fair value gap, we disrespected an old fair value gap. Now, displacing and zapping, right? Zap displacement that I use them, uh, to replace one another. If we displace and we close nicely above this, open of this 1 hour candle on the 5 minute, what does it show? It shows that Judas swing, open manipulation, right? The Judas swing. Now we're going to distribute to buy side liquidity. And look at the time. You see how the time of the hourly candle is starting to get close to the second half. This is where distribution is likely to kick in. If you consider the lifespan of an hourly candle on a 5 minute chart and the portions of accumulation, manipulation, distribution, is going to be the last one to kick in. Now distribution is not always one move. You can get distribution, retracement, redistribution, right? Seeing displacement above this candle's open around the time that we're in now of this hourly candle's lifespan, it shows that I'm going to be probably on side. And I think it comes here around, I think, 25 or 30 minutes into the hourly candle. Yeah, I think this begins the expansion. Like here, for example, there's no reason to cut the trade here. A lot of people see, oh, sideways, let me get out. You have this reference point in price. Forget this, right? Your reference point in price. If this gets disrespected, you're out, right? And that's the shape, right? Now, if the question you guys are thinking, why didn't I target the buy side high, right? You see from my entry where I saw where 2R was, I saw this was a 2R right here, the fair value gap. Now this, we could have found resistance in this fair value gap, right? Now I could have aimed for the high, right? And I was expecting the high to get hit. But what do I need? What is all you need? A 2R with a 2R with a 50 to 70% win rate is all you need. If you wanted to crack the numbers, right? If you just go and on paper and write plus two, minus one, plus two, minus one, plus two, minus one, see how much percentage or risk to rewards you have after 50 trades, right? The hard part is consistently doing it for 50 trades. People get to 10 trades and they try to, switch it up. I'll even make this statement, right, to you guys. You see how retail traders have their retail patterns, the wedge and the double top and the head and shoulders and whatnot. For us, entering upon different PDRAs every single trade is like the same as a retail trader trading a different pattern for every single trade. But people scoff and laugh at them because it's just retail. But people don't realize they're doing the same thing, but just in the realm of smart money concepts. So consider that, right? So that's going to be it for this trade breakdown. If you still have a question regarding it, do ask me. This model is going to be the main talking point of the weekly commentary. So I'll probably make that later on today, latest tomorrow, right, in the morning. So yeah, until next time, and I'll catch you guys in the next one.